In 2025, gold demand didn't just climb. It printed a number that belongs in a different era. Roughly 5,000 metric tons of demand in 1 year, valued around $555 billion. Not in a decade, not over a cycle, in 1 calendar year. And it happened while gold was already trading near record levels, the exact moment most people expect buyers to step back. And the tempo changed. Not months, not weeks. In 48 hours, a cluster of institutional signals landed close enough together that you could feel the market's posture shift. A central bank report here, a reserve data update there, a regional premium that refused to fade. On the surface, it looked like routine paperwork. In the background, it looked like a system preparing for friction. They said the dollar system could never be trapped, that it could bend but not break, that no alternative could scale and no rival could force change, because the dollar is not just a currency, it is plumbing, it is settlement, it is collateral, it is habit. Yet the market has a way of disagreeing with narratives when incentives move. Here's where it gets interesting. If you follow daily price candles, you'll miss it. But if you watch the slow variables that central banks, sovereign funds, and bullion banks watch, you see a pattern: persistent official accumulation of gold, rising sensitivity to sanctions and settlement risk, and recurring dislocations between paper claims and physical demand. This is not opinion. This is pattern. Welcome to Macro Decode, where we look past slogans and into the data that moves first. If you like understanding what matters before it becomes the headline everyone repeats, you're in the right place. And if you're listening from somewhere in the world where your daily life is tied to a currency you don't control, leave a comment with where you're watching from, because that lens changes how you hear the story. Now let's talk about what actually happened, because the central mystery isn't a single announcement. It's a stack of facts that refuse to sit neatly together. By the end of 2025, the World Gold Council estimated global gold demand around 5,002 tons. 3 tons of net purchases that year, and the fourth quarter alone came in near 230 tons. 5% of total reserves by that reporting framework, with about 27 tons added across the year. On the surface, none of that sounds like a trap. It sounds like diversification, sensible risk management, a slow bureaucratic shift. But place it beside the reserve system, 92%. That's still dominant. But dominance and permanence are not the same thing. A majority can shrink without drama until one day the system feels different. The dollar's unique power is that it is the default unit for global settlement and the default collateral unit for global finance. Energy, industrial commodities, shipping contracts, debt issuance, and derivative collateral all orbit around it. That network effect is huge. It's why challengers struggle. But networks can weaken if trust is politicized, if access is conditional, or if the cost of dependence rises. Over the last decade, financial sanctions have become more frequent and more sophisticated. In 2022, the freezing of a major country's foreign reserves was a shock to reserve managers everywhere, even those who publicly said nothing. The lesson wasn't about any one nation. The lesson was simple. Reserves can be treated as a policy tool. And once reserves can be treated as a policy tool, neutrality becomes a premium product. So the crisis unveiled is not a gold spike. The crisis is a confidence wedge forming inside the reserve system. The public sees stability because the dollar still settles most trade and still anchors most debt markets. Institutions see a different risk: the possibility that geopolitical friction, debt loads, and settlement fragmentation could slowly reduce the dollar's perceived neutrality. When neutrality declines, the appeal of an apolitical reserve asset rises. Gold is not perfect, but it is outside the ledger of any one government. And this has happened before. In the early 1970s, the Bretton Woods system began to fracture as U.S. gold convertibility became unsustainable. In 1971, the convertibility window closed and the world shifted to fiat regimes. Gold didn't merely rise, it reestablished itself as a barometer of monetary credibility. In 1979 and 1980, amid inflation and policy uncertainty, gold surged again, reflecting a crisis of confidence rather than a simple supply story. Then, decades later, in 2008, when global banking trust cracked, gold's role as a non-bank asset returned to the center. In 1971, an old promise broke and gold repriced. In 1980, inflation and credibility collided and gold repriced. In 2008, leverage and confidence failed and gold repriced. In the post-2020 era, the scale of stimulus, debt issuance, and geopolitical fragmentation created another version of the same condition: uncertainty about the long-term reliability of the system's anchor. The playbook is consistent. When the anchor is questioned, demand for the asset outside the anchor rises. Now bring China into that pattern. China's position in the global economy is uniquely exposed to dollar plumbing. It exports into dollar-priced markets, holds large foreign exchange reserves, and operates in a world where settlement rails are still heavily dollar-based. At the same time, it is the principal strategic competitor to the United States in economic terms. That creates an incentive mismatch. If the dollar is the operating system of global trade, China must run on it, but it also has reasons to reduce its vulnerability to it. The institutional movement becomes clearer when you stop looking for a single smoking gun and start tracking repeated actions. 3 tons keeps that trend alive at scale. The action isn't limited to one country, but China's cadence matters because of its size, its trade role, and its domestic financial architecture. Reported monthly additions through 2025 function as a signal. They tell the world that a major reserve manager is comfortable raising gold allocation through repetition, not through a one-off headline. And it wasn't just official reserves. The broader gold complex includes exchange-traded funds, futures positioning, refiner throughput, wholesale imports, and the behavior of regional benchmarks. China's domestic market, organized around the Shanghai Gold Exchange and its benchmark pricing, is built to channel physical demand through a regulated pipeline. That matters because it creates a feedback loop between local demand and local pricing. When local pricing persistently diverges from international spot, it is not merely a chart anomaly. It is a clue about constraints and priorities. Here's the part no one likes to say out loud. Gold is not merely an investment asset, it is also a strategic inventory. Central banks don't buy it for a quarterly trade. They buy it because it sits outside another government's promises, outside another banking system's credit risk, and outside payment rails that can be turned on and off. When institutions lean into gold, it implies they are assessing risk that standard instruments cannot hedge. A futures contract can hedge price volatility. It cannot hedge the risk of losing access. This is where the dislocation becomes central to the story. In a clean, efficient world, gold is gold. There is one price, plus transport and financing. But the real market repeatedly shows tension between the paper gold ecosystem and the physical flow ecosystem. Paper gold is the universe of futures, swaps, unallocated accounts, and claims that can be netted, rolled, and sometimes cash settled. Physical gold is the metal that must be assayed, shipped, vaulted, and delivered. Most of the time, these worlds rhyme well enough that nobody notices the seam. Consider how the Western price is often discovered. Futures markets, especially in New York, provide deep liquidity for price exposure. London's over-the-counter market provides massive volume in unallocated form, which is essentially a claim on a pool rather than a specific bar. That structure works because most participants want exposure, not delivery. But when more participants want delivery, or when more participants want metal held in specific jurisdictions, the conversion from claim to bar becomes the bottleneck. Now compare that to Asia. When demand rises in China, the pull is often explicitly physical. It is for bars, for jewelry, for domestic vaulting, for inventory that can be touched, audited, and used locally. When onshore benchmarks trade at a premium to international spot, it is a blunt message. Physical demand here is stronger than the paper narrative elsewhere. That premium can persist because moving metal across borders is not frictionless. Licenses, quotas, logistics, and policy all intervene. Two markets can therefore tell opposite stories at the same time. One says gold is plentiful because paper liquidity looks abundant. The other says the real metal is scarce where it is wanted most. And when that happens, the gap must close through one of only a few mechanisms. Either physical metal flows toward the premium market, narrowing the spread, or policy restricts flows, allowing the premium to persist and reinforcing fragmentation, or paper prices adjust upward to reflect the marginal value of physical immediacy. Let's build the evidence chain with numbers, because without numbers, this becomes a mood. Start with the record, about 5,002 tons of demand in 2025, with total value around $555 billion. 3 tons purchased in 2025, with about 230 tons in the fourth quarter. Those are official sector decisions made by committees with long horizons. Then China's reported holdings, around 2,306 tons at year-end, and reported monthly additions that imply a steady hand rather than a headline grab. Then place those figures against reserve composition. 92% for the dollar share of allocated reserves in the IMF's dataset in Q3 2025 is still majority status, but it is also a sign that reserve managers are gradually broadening the mix. The market doesn't need the dollar to lose its majority overnight for the system to change. It only needs the marginal trend to keep running long enough that funding patterns shift, hedging costs change, and the perception of safety becomes more conditional. Now look for contradictions that create tension. If the dollar is as unchallenged as the headline story implies, why the relentless official sector? Appetite for gold at high prices? If paper gold liquidity is so deep, why do regional premiums keep reappearing when physical demand surges? If reserve managers feel fully protected by existing instruments, why hold an asset that pays no yield and costs money to store? The answers all point back to one concept. The value of optionality rises when the rules feel less stable. This is what trapping the dollar really means in practical terms. It is not a movie scene where a rival declares victory. It is a slow narrowing of choices. The United States benefits from issuing the world's primary reserve currency. It can borrow in its own unit, fund deficits with a broader buyer base, and anchor global collateral with Treasury securities. But that advantage relies on foreigners choosing to hold dollar assets because they trust the system's neutrality and the issuer's long-term credibility. That is the trap. If the U.S. wants to preserve the dollar's centrality, it must preserve trust. But if geopolitical strategy leans on financial tools, the very use of those tools can motivate diversification away from the system. It becomes self-reinforcing. The more finance is weaponized, the more reserve managers value assets that are harder to weaponize. Gold is the most established of those assets because it is globally recognized, highly liquid in crisis, and not someone else's liability. China faces its own version of the trap. It holds substantial dollar assets because the system it operates in still prices trade and stores reserves in dollars. Selling aggressively would hurt the value of what remains and could destabilize markets China still needs to access. So the rational move is not a dump. It is a hedge. Add gold gradually. Encourage trade settlement in local currencies where feasible. Expand bilateral swap lines. Build alternative payment channels. Strengthen domestic benchmarks so pricing and liquidity are not fully external. That's why the institutional actions can look contradictory if you expect a dramatic pivot. You can see China still holding treasuries while also buying gold. You can see official statements stressing stability while infrastructure quietly builds redundancy. That is not confusion. That is risk management. Institutions do not announce transitions loudly because announcements move markets against them. They prefer gradualism and deniability, especially when they are managing hundreds of billions. Now, let's explain the mechanism that creates the most confusion: the paper-to-physical conversion stress. Imagine a stadium that sells tickets through a resale marketplace. The marketplace allows endless trading of rights to seats. Because most buyers never show up, they resell. It works until a large group decides they want to enter the stadium at the same time. Suddenly, the marketplace must produce real seats, not just digital receipts. If it can't, it raises prices, changes rules, or offers cash refunds. Markets have tools to manage that stress. Exchanges can raise margin requirements, which forces leveraged traders to post more collateral or reduce positions. That can trigger selling, pushing paper prices down even as physical demand stays strong. Banks can tighten credit lines for commodity financing. Vault operators can impose notice requirements. Refiners can hit throughput limits when demand shifts from large bars to different formats. Each step is rational on its own. Together, they create moments where paper prices and physical signals diverge in ways that confuse anyone watching only one screen. This is why you sometimes see a world where headlines say, "Gold is liquid," yet deliverable inventory feels tight in specific regions. It is also why you can see price drops that do not immediately kill demand. If demand is strategic, the buyer is not looking at a weekly chart. The buyer is looking at a decade of risk. So what does the pattern suggest going forward, historically speaking, if these trends continue? There are a handful of indicators that matter. One is the pace and consistency of central bank purchases, particularly when prices are elevated, because that signals motive beyond bargain hunting. Another is the behavior of regional premiums and discounts, especially persistent onshore premiums that imply sustained physical pull. Another is the stress signal in collateral and funding markets, because funding stress tends to expose hidden fragility before it becomes obvious to everyone. From that, three scenario paths usually emerge. In a conservative path, the system adapts smoothly. The dollar remains dominant, but its share gradually declines, while gold and non-dollar assets rise modestly as a hedge. In a moderate path, fragmentation accelerates during geopolitical stress, producing episodic spikes in gold demand and more frequent dislocations between paper pricing and physical availability. In a more aggressive path, a major settlement rupture, debt confidence event, or sustained inflation shock forces faster reserve reallocation and makes the gold signal harder to ignore. Notice what's missing. There is no guaranteed outcome. Markets do not grant certainty, but history does grant patterns. When credibility is questioned, hedges outside the system gain value. When settlement becomes conditional, neutral assets become strategic. When paper claims proliferate, stress reveals which claims are truly convertible. And when reserve managers act as if these risks matter, it is usually because they have already modeled scenarios the public has not considered. This is the divide. It is not between optimists and pessimists. It is between those who track institutional footprints in data and those who wait for consensus after the move is already priced. Institutions move first because they have access, mandates, and time. Retail moves last because it is fed narratives. The information gap becomes a wealth gap because the biggest transitions are priced before they are named. China's gold endgame, then, is less a dramatic final move and more a long campaign of optionality. Gold is optionality. It is a way to store value without relying on another country's promise. It is a way to settle, if needed, without asking permission. It is a way to communicate resilience without announcing intent. And when enough institutions pursue optionality at the same time, they change the pricing structure of trust across the entire system. To understand the players, zoom out from China alone. On one side sit the price discovery hubs, London's over-the-counter bullion trade built around LBMA good delivery standards, and New York's COMEX futures complex under CME clearing rules. These venues are optimized for exposure and hedging. Their strength is liquidity and claims, netting and leverage. On the other side sits the physical conduit, refineries, vault operators, customs channels, and exchanges that require metal to change form and location. That boundary is where stress shows up first. When metal must be shipped, assayed, and allocated, time matters. And time is exactly what stressed markets stop offering to late buyers. China's domestic architecture matters here. The Shanghai Gold Exchange is designed to clear through physical delivery, and its benchmark prices can reveal pressure that paper venues smooth over. When onshore demand is strong, the local price can hold a premium that effectively bids for metal to come home. That premium is not a rumor, it is a pressure valve. It tells you the marginal buyer is not trying to trade a contract. The marginal buyer wants inventory. Now add policy. The People's Bank of China sits above a system that manages capital flows tightly, so transitions are rarely theatrical. The State Administration of Foreign Exchange is tasked with stability and liquidity, so diversification tends to be incremental. That's why reported monthly additions matter. Repetition is the message. It normalizes gold as a reserve component, and normalization invites imitation from other reserve managers who share concerns about access risk. Then look at the American side of the ledger. The Federal Reserve sets the global cost of dollar funding, and the U.S. Treasury sets the supply of collateral the world posts in repo and derivatives. As issuance rises, the world can absorb it as long as treasuries retain their special status. But if marginal demand softens, clearing the same supply requires either higher yields or a larger domestic buyer base. That tension shows up first in funding markets, not in press conferences. Finally, remember how rule changes can move prices without any conspiracy at all. When volatility rises, exchanges raise margin to protect clearinghouses. That is ordinary risk management, but it forces leveraged positions to shrink fast. In 2011, repeated margin hikes in silver accelerated liquidations. The same mechanism exists across metals. Paper can drop while physical stays wanted. That divergence is the signal. There's also a quieter tell, custody preference. Over the last decade, more officials have talked openly about where gold is stored, not just how much is owned. You do not debate storage location for yield, you debate it for access certainty. If reserves can be frozen, then the location of a reserve becomes part of its risk profile. Pair that with the build-out of alternative settlement options, from bilateral currency swap lines to China's CIPS infrastructure, and the strategy looks less like a bet and more like redundancy. So trade can continue when politics interrupts finance. This is macro decode, where we connect what the market is doing to what the world is becoming before it is safe to say it out loud. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether the system evolves. The question is whether you recognize the signals before the evolution becomes the headline.